with current liabilities, we know we're dealing with liabilities or amounts we owe that generally are going to come due within the current operating cycle. So we're going to talk about what are liabilities, and we're going to determine which accounts are current liabilities. And then from there, we're going to be able to spend some time understanding how we record these liabilities, and sometimes we'll maybe need to estimate them. We'll talk about something called a contingent liability. Contingent liabilities are liabilities that may be out there, but we don't know yet. A great example of a contingent liability relates to warranties. Oftentimes, companies will have a warranty on their books in the event that there are repairs that need to happen on certain products. We don't know what those repairs may cost out there, but we will determine them and accrue them. Does that make sense? Because we don't know, but that matching principle, whenever we claim revenues, we want to also associate those expenses associated with those revenues. And so we are going to have some warranty expense, and so we're going to need to accrue that liability that's associated with that warranty expense. Then we'll talk about a concept called fair value accounting, and in that, at the time value of money. So a liability in 10 years from now of $1,000 is different than a liability today of $1,000. Why? Because of the time value of money. As money sits, it grows. So $1,000 in 10 years from now is worth less than $1,000 today. So we're going to talk about that. And then we're going to do some exercises that relate to using these present value tables and how we calculate based on interest rates that $1,000 in 10 years, what that's really worth today on our books. Okay, recognition. Now, you're going to see a lot of these concepts we keep talking about over and over again, because the whole purpose of accounting is with recognition and valuation and recording them, but they all relate to different types of accounts. Recognition, when do we record a transaction? Generally, when it's incurred. Valuation is how much do we record monetarily to a transaction. Classification is where do we record it, what account. And disclosure relates to what needs to be stated in the financial statements to help understand or describe our financial statements. Current liabilities are debts and obligations a company expects to satisfy, pay off, within 1 year or its normal operating cycle. Managers need to understand how current liabilities must be recognized, which means when to report them, valued, how much, classified, where, and disclosed additional information. Timing is important in the recognition of liabilities. What time period do we report them in? Failure to record a liability often means failure to record an expense. The two errors lead to an understatement of the expense and an overstatement of income. So what that's trying to say is usually when we have a liability, associated with that liability is an expense. Okay? Think about this. We had a serviceman come out. What happens when we get the bill from the serviceman? We debit the expense and we credit a payable, don't we? So do you see that if we forget to record a payable, chances are we've also forgotten to record an expense? And when we forget to record an expense, that means we show a higher net income than we really should have. And we generally also show lower liabilities than we really should have. Generally accepted accounting principles, also known as GAAP, get it? Generally accepted accounting principles, GAAP, require that a liability be recorded when an obligation occurs, such as when goods are bought on credit. So let's think of another example. We have inventory. We ordered and received $2,000 of inventory. What happens when we get that bill? What do we debit? Inventory. What do we credit? The payable, because we owe the money. Accounts payable. Do you see? So generally, when we buy goods, we're going to always, if we have we buy them on credit, we're going to also have a payable. We need to pay someone. We didn't give them the cash right away. We're going to give them the cash or pay it within 30 days or so. One reason for making adjusting entries is to recognize unrecorded liabilities that accrue during a period, as well as liabilities that can only be estimated. I know right now it sounds crazy that we have to estimate liabilities, but you'll see many times there's a lot of estimates that happen in accounting. We don't always know what the costs or expenses are going to be, and also the accruing or the matching liability. So sometimes we need to estimate it. Think of automobiles. How many of you guys have purchased an automobile that comes along with a warranty? And how does a company determine what type of expense they're going to have over the life of that warranty expense, that warranty of repairs, or I should say salaries, mechanic salaries, to take care of that vehicle? They don't know. But what they can do is estimate it based on past experience, can't they? Does that make sense? So there are some estimated expenses and associating liabilities that we don't know about, but we have to estimate them the best we can. And the reason we estimate them is because we always want to match the revenues we earn in the current period with the expenses associated with them in the current period. Does that make sense? On the balance sheet, a liability is generally valued at the amount of money needed to pay the debt or reported at the fair market value of the goods or services that are going to be delivered. But some liabilities we've got to estimate. For example, if an automobile dealer sells a car with a 1-year warranty on parts and service, the obligation is definitive because the sale has occurred, but the amount of the obligation can only be estimated. I mean, you might be one of these car owners that comes in every week because something goofed up. They're going to end up spending a lot more time on you and expense than they are maybe on the average person. Or, I'm kind of being facetious there, but the other deal is when a new model comes out, they don't always know up front maybe the issues that can go wrong with it. Okay? So they need to estimate it. Current liabilities are due in the next year or within the normal operating cycle, whichever is longer. And they normally get paid out of current assets or with cash generated by operations. Since they're due within this current operating cycle, they're going to use the cash made within this current operating cycle to pay the liabilities. They contrast with long-term liabilities, which are liabilities due beyond 1 year or beyond the normal operating cycle. A long-term liability may be a note on the building, and that liability, long-term mortgage note, may be 15 years. They're not going to pay that liability off in just this year. They're going to pay a portion of it off, but it's going to last 15 operating cycles. So they've got a long time to pay off that debt. Whereas when we're dealing with current liabilities, we've got to use the money we have on hand to pay off that liability. The distinction between current and long-term liabilities affects the evaluation of a company's liquidity. If you think about it, if I have $100,000 in liabilities that are current versus I have $100,000 in liabilities that are due within 10 years, which of those situations are harder on a company? Let me say it again. I have let's think of you guys. You have $100,000 worth of loans that are due this year. Or you have $100,000 of loans that are due in 10 years. Which one would be harder for you to pay? The short term would be harder to pay. That means you've got to come up with $100,000 now. Well, there is interest. You're right. So you're right. There will be interest associated with that. But for the purpose of the company needing to pay that off, isn't it going to be a little tougher to come up with $100,000 right now than it is to come up with $100,000 in 10 years? You're right, there's interest. We're not taking that into account right now, but that is a piece of the equation, okay? But it's going to be tougher to come up with $100,000 in the next 10 months than it is to have 120 months, okay? So when they say that the distinction between current and long-term liabilities affects the company's liquidity, what that means is the more debt you have as current liability, the tougher it looks on a company. If one company has $2 million of current debt and one company only has $2 million of long-term debt, this company that has the $2 million of current debt is probably going to be in a little tougher situation. Does that make sense? Because it's happening soon. It's coming due real soon. In addition to reporting liabilities on the balance sheet, a company may need to include additional explanations in the notes to the financial statements, such as if the company's note payable account is large, it needs to disclose what's in that note, what specifically is, how is that note set up, or any special credit arrangements need to be disclosed. So, let's look at this. Indicate whether each of the following actions relates to a recognition of a liability when it's being recorded. The valuation means how much. The classification means where. And disclosure means additional information. That's how I kind of equate it in my head. Determining whether a liability is current or long-term. Is that going to be about when, how much, where, or extra? Where? Determining the dollar amount of a liability. Yes. Determining what information should be reported about a liability. Disclosure. Determining that a liability exists. Recognition. Okay? So, how do we record these liabilities? We need to know how much to record. So, the first thing, the statement here says record definitively. No, definitely determinable current liabilities. They're definite and we can determine them. We're going to record these. We also need to record estimated current liabilities. We may need to account for certain contingent liabilities. And we're going to look at some present value concepts. So current liabilities that are set by contract and that can be measured exactly are called definitely determinable liabilities. These include what we owe suppliers, what we owe banks, short-term notes payable. So promissory notes are notes we may owe banks or we may owe an individual or a company. And usually those notes have a promissory note or a written contract per se attached. Here's an example of a promissory note. It really is pretty straightforward. It has the date. It has the time. 60 days. When? I promise to pay who? First Federal Bank. How much? The sum of $16,000 with interest of 3% per annum. Who's involved in this? Teresa's Fitness Center and First Federal Bank. Does that make sense? So, recognition is, do we have something? Yes, we have a promissory note or a note payable. Valuation is $16,000. When is now. Where are we going to record it? As a short-term liability because we know it's going to be due soon. Does that make sense? So, here's an example. Borrowed $16,000 from the bank and signed a 60-day 3% promissory note. What are we going to do here? We're going to record a journal entry to show this transaction because it has created, it's a business transaction that has an economic event. So when we borrow that money, what happens to our cash? Goes up. What happens to our liability? It goes up. So we debit cash of $16,000. We credit a notes payable of $16,000. The normal balance of an asset is a debit. The normal balance of a liability is a credit. Do you see how both increased? We show here we issued a 60-day 3% promissory note. The transaction is recognized by an increase in assets and liabilities. Now on March 1st, Teresa repays the $16,000 she owes plus interest. We have a business transaction, don't we? An economic event. When we record this journal entry, we are going to increase our interest expense. We're going to decrease our liability, or our notes payable, and we're going to decrease cash. So, we show a debit to notes payable of $16,000. We don't owe it anymore because we just paid it off. We are also going to calculate how much interest we owe, which we're going to look at in a minute. But when we pay our cash, we're not just going to pay that $16,000 we owe. We also owe them some more, the interest. So we're going to decrease our cash or credit it by the payment, the loan plus the interest. Now the way we calculate the interest is we take our $16,000 that we borrowed times 3% or 3 over 100 or 0.03%, 0.03 times we borrowed that money for 60 days, but we have 365 days in a year. So remember, 3% is the annual interest rate. We're not going to pay 3% for just 2 months. We're paying 3% over a year. So we need to determine how much we're really paying in interest for 2 months or 60 days. So if we take the amount, $16,000 times 3% times 60 divided by 365 days in a year, we come up with $78.90 of interest. Okay? So our interest is $78.90, and we need to pay them the principal amount of the loan of $16,000 plus the $78.90. This transaction is recognized by a decrease in assets. Why assets? Because we don't have the cash. We used up cash. And a decrease in liabilities. Why? We don't owe it anymore. And an increase in interest expense. Although a company signs a promissory note for the full amount of a line of credit, it can increase its borrowing up to a limit when it needs cash and reduce the amount borrowed when it generates enough cash on its own. So basically, a line of credit is money available when you need it, but that doesn't necessarily mean you take it out. You only take it out when you need it. Companies with really good credit ratings can borrow short-term funds by issuing something called commercial paper, which is unsecured loans that are sold to the public. So commercial paper is a form of an investment, and it's a way companies can raise money fairly quickly. Okay? How do they raise it quickly? They need cash, so they go to people that have that cash, and they're going to pay an interest rate on being able to borrow that cash, and the people that have contributed that money are going to earn interest on that money. Now, if it's a company with a really good credit rating, you're pretty likely to get your money back. So that's why it says excellent credit ratings. If I tell you I'm going to do an upstart company and it's a real risky venture, hey guys, anyone out there want to lend me some money? I'm going to pay you 20% per year. Wouldn't you jump on it? Maybe not. Why? Might be risky. I might go down and you're going to go down with me. See what I'm saying? If it's a solid company that's been around for a long time and they need money, they're probably going to be pretty solid. You can pretty much guarantee you're going to get your money back. But it's not as risky as what I want to do. So you're not going to get the interest rate, but chances are you're going to get your money back. Make sense? You don't get the reward without the risk. The greater the risk, the greater the reward. Okay? You can't have one without the other. A key reason for making adjusting entries is to recognize accrued liabilities that are not already in the accounting records. Some of these are going to include some estimated liabilities, interest payable, which we're going to exactly know how much we owe because we know how much interest accrues on a daily basis or weekly basis, so we can figure that out. So here's an example, guys. The accounting period of Teresa's note in Exhibit 1 ends on January 31st, or 30 days after the issuance of that 60-day note. So if we go back here, do you see how her note started, borrowed $16,000 from the bank, and so on January 1st, we showed this transaction. But the books get closed at the end of the month. So on January 31st, we're going to close these books. Now we know she's going to owe interest at 3%. What they're wanting us to do now is figure out on January 31st, or 30 days after the issuance of the note, we've got to accrue the interest she owes on that note. So, think about this. Even though we're not going to pay it for 30 more days, we still need to record it in the period in which it was accrued. So, we need to figure out our 3% on our $16,000 times 30 over 365 days. Or that month, we showed $39.45 in interest. So our interest expense increased and our interest payable increases because we didn't pay it yet. We were accruing that payable. Okay? Now, those people who may own stock in a corporation, oftentimes what happens is you purchase equity in a corporation through the means of purchasing stock. And so you're basically an owner in the company. The way the company pays you is by giving you dividends, giving you a share of what the company made throughout the year. Cash dividends are a distribution of earnings to the corporation's stockholders. Now, the board of directors of the corporation has the authority to declare, we are going to give dividends. We have cash available. We need to reward our shareholders so they keep investing with us. A corporation has no liability for dividends until they decide that date they're going to declare dividends. The day in which they declare dividends, a liability opens up for them. They've declared it, they need to do it. During the period between the date of the declaration and the date of payment of the dividends, the dividends declared are considered current liabilities of the corporation. Once they're declared, you better pay them. They become a liability. Most states and cities levy sales taxes on retail transactions. So I went to Best Buy yesterday. I am having the hardest time with my computer. For some reason, this sucker, see, it just turns off. I think something's wrong internally, but I thought it was my power cord. So I went and bought a new power cord for $53, and I paid about $5 in, darn it, in sales tax on this power cord. Now, Best Buy collects that sales tax, right? And what do they need to do with it? Ultimately, they need to hand it over, don't they? Since I was in the state of Minnesota buying this power cord, and since Best Buy in Apple Valley owes that sales tax to the state of Minnesota, they're going to have to collect my money and turn it over. The federal government imposes things called excise taxes. This is more for gasoline. Merchants that sell goods subject to these taxes must collect the taxes and forward them periodically to either the federal government or the state. Until the merchant remits that amount it has collected, that amount represents a current liability. Does that make sense why it's a current liability? It's not theirs to have, is it? It's theirs to give back. They're only safekeeping it until they turn it over. So, the way they record that is right here. So, as you see right here, on June 1st, Teresa's Fitness Center makes a $200 sale of nutritional supplements that is subject to a 5% sales tax and a 10% excise tax. So, they sold goods and they made $200, or they received $200 from the sale of their product. But in addition to that sale, they also collected sales tax and excise tax, right? So we need to show on that $200 they had a sales tax and an excise tax. They collected $230. Cash came in of $230. Now, the credit is to sales. A revenue account has a normal credit balance. They sold an item for $200. They also then need to show who they owe that money to. They have a sales tax payable of $10. They have an excise tax payable of $20. So you see they brought in $230. $200 of it relates to the sale of their product. $10 of it needs to go to the state. $20 of it needs to go to the federal government. That's why those are payables. It's not their money. They're just safekeeping it to turn it over. Does that make sense? The sale is properly recognized at $200, and the taxes collected, which are not revenues, they're liabilities. They're remitted to the appropriate government agencies. A portion of long-term debt that is due within the next year and is to be paid from current assets is classified as a current liability. So remember I told you what's better, paying $100,000 in debt this year or $100,000 in 10 years? But what if $10,000 of that $100,000 due in 10 years is due this year? That amount that is due in this current cycle is going to be recorded as a current liability. The total debt gets reclassified as short-term and long-term when the company prepares its balance sheet and other financial statements. So we're going to look at that. Another type of liability relates to payroll taxes. Employers are liable to employees for wages and salaries, and to different agencies that for them withholding federal taxes or state taxes or Social Security taxes or Medicare taxes. So when they pay their employees, they also have held back the federal taxes that they withheld from their check and the state taxes. Those don't belong to the employer. They need to go somewhere. So when we're dealing with payroll, we have wages. We all know what wages are. The money we earn, or I should say for employers, the money they pay the employees is compensation to do the work. Wages are hourly, salaries are a monthly or yearly rate. An employee is paid a wage or salary by an organization and is under its direct supervision and control. Payroll accounting relates to just the accounting for employees and those payroll taxes. Independent contractors generally are on their own, and they work for a flat amount. Therefore, the person they're working for doesn't have to withhold payroll taxes because they're not an employee. So as you see here, this shows all the various costs related to payroll. We start with the employee's gross wages. As you can see here, from here to here, list their gross wages, which basically, if you take their take-home pay, you add to that the federal income taxes that have been withheld from the check, you add to that the state and local income taxes, you add to that the FICA and Medicare, and possibly medical insurance if they have a government plan, and potentially pension money that got withheld. This consists of the employee's wages or salary. And they only get the cash of a small piece of all this, don't they? How many of you guys have ever looked at your paycheck and said, oh, I brought home 50% of what I grossed? It can get depressing. But there's a lot of different pieces that have to go to different places. So when we're dealing with payroll, one half relates to the employee's wage or salary, and all these different places we've taken the money out of, we need to pay them to those respective places. The take-home, or the cash we gave them, is going to reduce our cash, but there's a lot of other money we're going to have to send to different places. On the other hand, the same amount of Social Security and Medicare that an employer takes out of the employee's paycheck, the employer has to match it. So when there is a paycheck of $1,000 this week and the employer took out 6.2% Medicare, Social Security or FICA and 1.45% Medicare, the employer has to match it. They have to pay in that exact same amount of their own money. Over here, they withheld it from the employee's check, but now they have to also pay it. So the employer has some things they need to do over here too. They need to pay for FICA for the employees. They need to pay their share of Medicare tax and possibly medical insurance for their employees. And depending on what type of pension, the employer may have a pension, a portion of their costs they need to pay in for the employer. In addition, there's some costs you don't even know about if you're not an employer. There's a federal and state unemployment taxes they're responsible for paying on behalf of any employees you have. So the federal and state unemployment tax go into a fund to help those workers when or if they ever get unemployed. So when we deal with payroll taxes, we're dealing with federal income taxes, those that the employer has to withhold and pay into the U.S. government. We're dealing with state and local income taxes, FICA, Medicare, medical insurance. Usually employees have to contribute a piece of it. If it's for the federal plan, then they pay in. If it's like where I work at DCTC, the state of Minnesota pays in a good portion of my medical plan, but I still am responsible for a portion of it. So they withhold that from my pay, and yet they have to pay it over to the insurance company. Pension contributions, same thing. I have to have a certain amount of my pay that goes into my pension each month. So they withhold that and send it to the appropriate place. FUTA and SUTA, those aren't monies that get taken out of my check. They're monies that have to go in for the employer to pay for. So let's look at an example here. On February 15th, Teresa's Fitness Center's wages for employees total $65,000. And the withholdings for employees are as follows. $10,800 for federal income taxes, $2,400 was withheld for state income taxes, $4,030 was withheld for Social Security taxes, $942 was withheld for Medicare taxes, $1,800 for medical insurance, and $2,600 for pensions. So when this transaction occurs, we've got a couple accounts we're going to have to adjust. The wage expense for reporting these wages is a debit. We're increasing our wages expense, but we're going to have a lot of payables that we're going to increase also. So here's the journal entry you see. It shows a debit to wages expense for $65,000. We credit that amount we owe in federal income taxes that we took out of the employee's paycheck. We owe the state income tax that we took out of the employee's paycheck. We owe to Social Security the amount we took out for FICA. We also owe Medicare taxes that we took out for the employee. Medical insurance premiums payable, that amount of the employee's portion of their medical insurance we took out of their paycheck, we owe that to the insurance company. The pensions also. The differences are going to be how much we owe the employee now, the take-home pay. So do you see here, the expense, the wages expense is the debit. The credit are all these short-term payables. The payables all need to be paid within the current cycle. Okay? Wages expenses recorded for the gross wages, but the various withholdings are recognized as liabilities before net amount payable to employees is determined. Although the employees earned $65,000, their take-home pay was only $42,428. So about 25%, 30%. And that's good. Back in the 70s, the top income tax rate for individuals, federal income tax rate, not state, just federal, was 70%. Which means for every $100, if you were in that bracket, for every $100 you make, you pay the federal government 70 of it. That's not even state. My point being, all we know, and I'll speak for me, is today, because I'm in it now, but it's been way worse. And it's way worse in a lot of countries, too. It's hard to imagine it could be worse than what we've got it, but it is. It's crazy, isn't it? So, on February 15th, Teresa records the fitness center's share of payroll taxes, the health insurance premiums, and the pension contributions. So they also have to match the payroll taxes. The health insurance premiums, they pay a lot more than what the employee pays, and the pension, they contribute the same amount. So as you see in this journal entry, we debit the expense, payroll taxes and benefits expense. We credit the Social Security payable, the Medicare payable, the medical insurance premiums payable, the pension, the federal unemployment, the state unemployment. The moral of the story is, it costs a lot of money to have employees. But companies need them to operate, don't they? Note that the payroll taxes and benefit expense increases the total cost of the payroll to $83,000. Remember, the gross wages were at $65,000, but then all these costs total up to $18,802. So really, to have an employee, you're not just paying out the $65,000, you're paying out $83,802, which exceeds the amount earned by the employees by almost 29%. So whenever you see your wage, you make $40,000, usually by the time you're all done, the true cost to the employer is usually about 30% more than what you're getting. Let's take a moment and do some problems. How are you guys doing? You okay with that? Okay. Let's look at E2A on page 441. E2A. Okay? E2A basically shows us okay, sorry about that. On the last day of October, Lake Company borrows $60,000 on a bank note for 60 days at a 12% interest rate. Interest is not included in the face amount. Prepare the following journal entries: the October 31st recording of the note, the November 30th accrual of the interest expense, and the December 30th payment of the note plus expense. So October 31st, we borrow the money. For the end of November, we need to accrue it. And then the end of December, we need to pay it. $60,000, 12% interest rate. Okay? So as you see here, on October 31st, our cash will increase $60,000. But in addition to our cash increasing, our note payable will also increase $60,000, won't it? So that first journal entry shows October 31st, a debit to cash of $60 and a credit to notes payable for $60,000. It says bank loan for 60 days at a 12% interest. That's not included on the face amount of the note. Now, come November 30th, we're not going to pay this note for 30 more days, but we need to accrue how much we owe the bank so we can show it on our books accordingly. It's a 12% interest rate, and already 30 days have accrued. So the way in which we calculate the amount of interest that has accrued, we show the $60,000 note times 12%, or 12 over 100, or 0.12, times 30 days divided by 365 days in a year, which is $591.78. Does that make sense how we're calculating that, guys? Yes? You get it? Now, 30 days later, we have to pay the note. But we don't just pay the note, guys. We also have to record for that month how much was accrued on that note also. So as you see here in December, we have to show we're paying off the whole $60,000. We have to show that interest that we showed in November 30th, $591.78. We're paying that off. We also have to record the interest from December 1st to December 30th, don't we? Which is $60,000 times 12% times 30 out of 365 days. And we're going to show that as an interest expense. But since we're paying this note off right today, we don't have to necessarily show a payable for that interest. We can just add it to our cash. So you see, instead of just paying $60,000, which is how much the initial note was, we're paying $61,183.56. We're paying $591.78 from the interest we recorded the month before that we showed as a payable. And then we also accrued, showed the interest that was accrued this period of this month, $591.78. And the total is the $61,183.56. Does that make sense? How you guys doing with that? Yes? No? I want you to now look at P2. P2. This is a homework problem on page 444. This says, Blue Blaze Company, whose fiscal year ends December 31st, completed the following transaction involving notes payable. On November 25th, purchased a new loading cart by issuing a 60-day 10% note for $43,200. So he needed to borrow money. On November 1st, he took out a loan. On December 31st, he made the end-of-year adjusting entry to accrue the interest expense. Now, guys, he's not going to pay this note off until January 24th. But since on December 31st, it's the close of his accounting period, he needs to accrue it. He needs to accrue that amount of interest that has been expensed. Then on January 24th, he paid off the note along with the interest. So what I want you to try to do on your own for the next 5 minutes is I want you to look at this scenario, and based on that problem we just went over, what is the November 25th entry? What is the December 31st? And the January 24th? Does that make sense? P2, are you guys ready for this? November 25th is when we're going to record the liability, okay? So the liability basically is going to be shown as, let me find it, November 25th, equipment, $43,200, because he didn't get the cash, he got a piece of equipment instead, right? We'll credit notes payable of $43,200. And basically we're showing purchase of loading cart with a 60-day 10% note. Okay? Then, on December 31st, when the books are closing, he needs to show the interest that should be linked with this period. Because, remember, the whole goal is to match our revenues with our expenses. Well, if he took out a loan on this year, we need to record that interest that accrued this year, apart from just when he paid it, when he actually incurred it. So the way we calculate the amount is to show from November 25th through December 31st, we've got 5 days in November, we've got 31 days in December, So 36 days, we take the $43,200, the loan amount, times the interest rate, 10%, times 36 days divided by 365 days. Or we have $426.08 we're going to show as a debit to interest expense and a credit to interest payable. Now, if he chose, instead of accruing it, if he chose to pay it, the only thing we'd have done different is debit interest expense, credit cash. Okay? Does that make sense? Any questions? Now, the next one we've got here is finally he paid it on January 24th. Okay? So we know we've got the note of $43,200 he needs to pay. He needs to pay the interest payable from December. Plus, we need to calculate how much interest has accrued in this period, has incurred in this period. So we take that $43,200 times 10% times 24 days divided by 365 days, or $284.05. So you basically have the interest expense from this month, the payable from the end of the previous cycle, and between the note payable, the interest expense, and the payable, all of it totals our cash of $43,910.13. Any questions on that, guys? Now, we're going to move back to page 441. Let's look at some other examples of liabilities. Sales and excise tax. Lindstrom Design Services billed its customers a total of $245,100 for the month of August, including a 9% federal excise tax and a 5% sales tax. Determine the proper amount of service revenue to report for the month. Prepare a journal entry to record the revenue and related liabilities for the month. So, as you see here, the $245,000 includes our 9% excise tax and our 5% sales tax. So if you think about this, let's get on our math hats, our algebra hats. $245,100 includes all of it, okay? But we want to break out and only show what our sales are, because the rest we pay in. So if 9% is excise tax, 5% is sales tax, that totals 14%. Okay? So our sales are 100%. We collected excise tax and sales tax of 14%. So if we take this total amount of $245,100 and we divide it by 1.14. We'll calculate how much is for just the sales. Think about this. Sales are 100%, but between the two taxes, we added 14%. So if we take our 245.1, divide that 1.14, that shows us the sales are just $215,000. Does that make sense? Okay. The sales plus a 5% sales tax plus a 9% excise tax equals our total amount. Okay? So we could say X, which is our sales, times 14% of sales equals $245,100. Does that make sense? Let me just get in here and show an example. Here's another way of looking at it. The way they're showing it is the easiest. But here's another way you can look at it. No. Come on. Okay. Right now, we know the sales times 14%, okay, equal how much? 245,000, right? So, sales equal 245,100. So sales can equal 245,000 divided by 14%. Sales, oopsie, equal, oh, come on, let me figure. Sales is at 100%. I need to divide it by 1.4. Okay, so if sales are at 100% and the sales tax is 14% of this amount, okay? So if we say this is X, or I'm going to call it X, time, how about we'll call it S. S times 14% of S, because you know the sales tax is 14% of sales. That's going to equal 245,100. Does that make sense? Sales times 14% of sales, not X, but sales, equal 245,100. Okay? So what we need to do is 1.14 of sales equal 245,100. We divide each side by 1.14 to isolate the sales, S on its own. S equals 245,100 divided by 1.14. Then you know that S equals, what did we say, 215? So this is algebra basically. You know how you have a variable and you figure out sales times, if the sales tax is 14% of the sales, you kind of do a little bit of math here to calculate. You have to divide both sides by 1.14 to come up with what the actual retail amount is. So if I go back here and we see the 245,100, divide that by 1.14, comes up with 215,000 is the actual sales. Then our service revenue. Then we have to take 9% of the service revenue is going to be our federal excise tax. 5% of is the sales tax revenue. So all of it totals our 245.1, but we have to isolate how much is revenue and then how much we owe to excise taxes and how much we owe to sales tax. Does that make sense? Any questions on that one? Okay, next one. E4A. E4A says at the end of October, the payroll register for Noor Tool Company contained the following totals: wages, $371,000, federal income taxes withheld, $94,884, state income taxes withheld, $15,636, Social Security taxes withheld, $23,002, Medicare taxes withheld, $5,379.50, medical insurance deductions, $12,870, and wages subject to employment taxes, $57,240. Determine the total and the components of the monthly payroll and the employer payroll expense, assuming Social Security and Medicare taxes equal the amount for employees, a federal unemployment insurance tax of 8.8%, and a state tax of 5.4%, and medical insurance premiums for which the employer pays 80% of the cost. So I want to give you 10 minutes to go through this. If you need a break, take a break now. Let's take 10 minutes and go through it, and then we'll come back and look at it. I'm doing this so everyone has an opportunity to explore it on your own.